In the Wall Street, the market decides the price. It does not matter how accurate or sensitive to inputs your security pricing models are. If the market is not in consensus with the pricing of a security, it will never reach the price predicted by your model in the short-term trading period. The price of a security trading in the market is a function of the fundamentals or the intrinsic value, that is business performance of the security, and the market sentiment involved. When there is a positive attitude among investors, which leads to buying, prices rise. There is an expectation that prices will move in the upward direction and the sentiment is said to be bullish. The term bull is coined since a bull generally attacks with its horns in an upward direction. Similarly, a negative attitude among investors will lead to selling, resulting in falling prices. There is an expectation that the prices will move in the downward direction, and the sentiment is said to be bearish. The term bear is coined as a bear attacks with its limbs in the downward direction. So, how exactly do we play with these sentiments in the market? For instance, a company declares positive quarterly earnings, which beats the market estimates. The stock of this company would reflect this in its activity. Its price will move in the upward direction. Since a high traded volume may also suggest a change in the intrinsic valuation of the security, we need to understand if the drift in the upward movement of prices is caused by the bulls after an upward adjustment of its intrinsic valuation. This can be called mispricing of the security due to a strong bullish sentiment prevailing in that security. Trading is done by taking positions to capitalize based on these sentimental drifts, which lead to mispricing of securities from their intrinsic values. Similarly, mispricing can also be caused by bears in the market. It is important to understand the intrinsic value and adjustments in the same caused due to event-related drifts in prices caused by market sentiment, and finally capitalizing on such mispricing when it comes to sentiment trading. In the course, Trading Using Options Sentiment Indicators on Quantra, we will teach you 3 sentiment indicators, namely the put-call ratio, TRIN, or Trading Index, VIX, or Volatility Index. Happy learning!